Well, and what would you say? Because I think a lot of people tend to look at the typical way of diversification was kind of that 60-40 portfolio mix, right? And then everyone pointed to 2022 as being a disaster for the 60-40
60
portfolio.
40, yeah.
So you don't necessarily restrict yourselves to just two assets, so how do you achieve your diversification? How many different asset classes are you looking at?
Well, let's see. In general terms, I trade, I don't know how many asset classes. I have grains, meats, metals, both precious and industrial, debt instruments, stock indices, lots of soft commodities, so everything from lumber to orange juice, cocoa, all that stuff.
So you don't really restrict yourself.
No,
You'll play anything.
yeah,
And I
well,
guess,
I have Bitcoin and Ether futures too, long and short.
and I guess one more question here is the other problem sometimes is that I feel like a lot of times, like with the 60-40 portfolio, bonds and stocks mix, people will sometimes say, okay, well, I've got uncorrelated assets, but then sometimes during crises, they have the correlation of crisis, right? Where all of a sudden these typically uncorrelated assets start getting really correlated. And
They're
that can happen
either
on both the positive side or the negative side.
they're either positive one or positive
Right,
minus
exactly.
one.
Yeah,
Yeah,
people are going crazy with their euphoria, or they are just like the sky is falling and nothing will work.
and they're having a really bad day.
Right. So how do you kind of recognizing when,
Well,
and again, a lot of times that crises happens with higher volatility and everything like that. So do you have measures of kind of recognizing when the correlations are getting too close?
what I do to offset that, first of all, let me coin a word for people that we used at Trendstat. I have no idea whether anybody else used it. We used it because it was to talk to each other, the computer department, the traders, and we called it lockstep. When markets in general go hyperbolic, they just get crazy. The news is, wars breaking out, or there's oil embargoes, or whatever is happening. Tariffs get announced. You get these tendencies to have all of the markets, even things like live cattle or corn or something, they seem to get excited too. So I assume when I'm sizing my positions, I assume 1.0 or minus 1.0 correlation, because that way I'm always prepared ahead of time for the days when the you know what hits the fan. And that's how I deal with it, is I get ahead of it and I lock that into my thinking of how much risk and how much volatility do I want any one position to be of my equity. So I got an equity every day. I can see it on the screen. I got a position I'm about to put on. If I do a futures contract, let's say I'm going to buy sugar tomorrow, it's going to be 0.35% of my equity, the risk of that. The volatility, as measured by the ATR, average true range, over the last 21 days, for sugar is going to end up being 0.2% of my equity. Whichever answer gives me the lower amount of contracts, that's the amount of sugar I'm putting on if it breaks out. So those are my exact numbers, those are my exact formulas. And I cover that in the Successful Traders Size Their Position book that I wrote a few years ago. The math is in there. You learned it in junior high school. It's not tough. Don't
Yeah.
have to be a rocket scientist or a chemical engineer to be able to do it. A simple spreadsheet or a calculator can handle it.
That's
And
what I
that,
was going to say. That's the benefit is you can just have it in a spreadsheet, and
yeah.
if you don't like math, it can be just done for you. And
Yep. And you
you
can
have
extract the formulas right out of the book and put them in your spreadsheet and you're done.
uh-huh. Yeah.
It's not that hard. You just have to kind of think through these things and get ahead of it. Don't be doing it when you're about to buy the sugar contract. Have all these things in place so that when the trade comes along, you can do boom, boom, boom. There's the answer. Put into, there you go.
I want to switch a little bit back to the current market because
Okay.
there is, again, a lot of, I think, people kind of wondering a lot of what you've done. And I'm just going to go to one of the questions that I got here on YouTube. People are maybe wondering a little bit about how things have changed over time. Algos, market makers, all of that. Has that kind of have you seen kind of a shift to your models because of the change in volume? The options market even has swelled so much, and futures as well. All these different, uh, all these different products that are available now that weren't available 20 years ago.
Yeah, I was talking to a mutual fund manager, calculated, he gets into alternatives, and he said when I started the fund, I thought we had about 9 billion in potential capacity. And this is, he had certain criteria how he calculated that. It was based on the liquidity being a certain percent of the volume daily of each of those markets that he's participating in. So the 9 billion number was calculated, and he had this nice formula and spreadsheet to figure it all out. I saw him just a couple months ago, and I asked him the same question about how much capacity do you think you have now with all these things going crazy. He said, I just did that calculation strangely about 2 weeks ago, and it was 19 million or 19 billion.
19
So
billion.
9,
Okay.
9 billion going to 19 billion. He's more than doubled
Hmm.
what he perceives to be his normal capacity without making any changes to his investment strategy. So
Hmm.
the answer is, if you're a little guy like me, and I don't have any clients, I don't manage $1 billion, I'm just managing my little retirement portfolio, and in the whole scheme of the world, it's chump change. I can go in and out with anything I want in any market, and it's a super advantage over what I even had to do back in Trendstat. Trendstat wasn't the biggest manager on the block, but we had a good size. We were at 600 million back in $2,000,
Hmm.
$1998, and those dollars were worth a lot more than those dollars are worth today. So we've been like managing today's world, maybe 1 to 1.5 billion or something, if you adjusted it. But the point I'm making is that when you are managing a larger chunk of money like that, you really have to work it a bit. It's not as
Hmm.
easy, but when you're a small investor, like I suspect a lot of the people listening to this program would be, you've got a big advantage. You really don't have to be worried about buying the dip because you're Warren Buffett trying to take over 10% of Coca-Cola or whatever.
Hmm.
You're really just dancing in and out whenever you feel like it. And commissions have become so inexpensive, bid-ask spread so tight in many cases. It's the trading costs have gone way down from when I was doing all this by telephone and written pieces of paper back
Right.
in the 1970s.
Yeah.
Nowadays, I stick an order over here on my trading machine, which is over this side of me. And by the time I turn my head and look down that way, there's already a confirm in the lower part of my screen.
Uh-huh.
It's that fast, and
Yeah.
it's crazy. So
Yeah.
it hasn't changed a lot of my strategies. What I think happens, if I could encapsulate all of the evolution I've seen in 50 years of trading, everything just happens faster.